Studios, the ausbiz COB is the key stuff you need to know about the day in business and finance.
All right, welcome to the COB. I'm Juliette Sarli. On what is a down day for the first day of February, we hit that record high yesterday. A potential window dressing, although Martin Lakos and Macquarie are just telling me there, no, look, we've been seeing quite a solid rally for some time, but certainly that movement that we had yesterday was built on that cooler inflation picture. But then overnight, the Fed very much pushing back against a March rate cut, and that saw quite a bit of wobbliness, you could say, coming through in US markets, also setting our market up for a negative day. And of course, it is the first day of a new month. The CBO 200 there down 18 points, 1.2%. Just having a look at where the ASX 200 is, down 94 points, 1.2%, 7,586. So we have fallen back through that 7,600 point level. And just having a look as well in terms of some of the moves you're seeing in sectors. CBA coming off that record high, down by about 2.8%. And miners also under pressure, off by around 0.4%. All right, in terms of what we've been watching, of course, it really has been about the Fed holding. When is the next when is the cuts, I should say, going to start? I read a really interesting piece from TD earlier saying it's going to be May, a play, of course, on that NSYNC It's Going to Be Me song where it sounds like May. So potentially markets pushing out March. Jay Powell himself virtually indicated that. But could we see cuts from May? Martin Lakos certainly indicated that, and we're going to speak to Mark Gardner in a moment for his thoughts too. The ASX, though, of course, dropping there. Let's have a quick look at some of the sectoral moves as well. I mentioned CBA coming off a record high, down 2.8%, $114.41. NAB, Westpac, ANZ, Bendigo and Adelaide also under pressure. Having a quick look at some of the industrial stocks as well. Look, they're all in the red, and IT stocks too. When it comes to WiseTech Global, down 1.4%. And some of the top stories of the day. Metcash, look, it looks like its shares unchanged, of course, as they're in a trading halt, confirming they're in discussions with vendors over a potential takeover of Superior Food Group. Metcash saying discussions are incomplete. There's no certainty they'll lead to a transaction. Changes at the C-suite at Bapcor. We saw its share price rise 1.8%. Nufarm coming under pressure. It actually fell the most in 1.5 years on a bleak half-year outlook, telling shareholders at its AGM today that's a result of challenging conditions in crop protection. On Coastal Medical, meanwhile, up 50%. It is a 1 cent stock, though. It has signed an exclusive agreement with EDH Nuclear Medicine, and healthcare services to distribute its product in Turkey. And BCI Minerals, they're raising $315 million through a mix of an accelerated, non-renounceable entitlement offer and placement. All right, let's get straight to our guest. Mark Gardner from MPC Markets joins us now.
Good afternoon.
Hi. Your thoughts on what we heard from Jay Powell and the timing now for rate cuts?
They were super cautious, realistically. Data dependent, but he was uncharacteristically quite uncertain in his tone, I think, overall. And look, the March cuts, really, that's just the market putting pressure on them for the March cuts. March cuts were never realistically going to happen. We'd never actually priced them in at any stage because there was not enough data to come out for them to, make an unequivocal pivot in rates. So, the first one's first shift into a new cycle is always very important, and every central bank's going to want to be certain. 1 month, 2 months doesn't really make a huge amount of difference in the scheme of things. I think that markets have, obviously bond markets particularly, have been pretty volatile. It was only 3 or 4 months ago we were at sort of 5.2 in some of these 10-year treasuries and things, and now we're back below 4. So I think the market just got very much ahead of itself. I think higher for longer is probably the message that they've been very consistent with and will probably stay with. And the Fed's got a different mandate. I think we're just in controlling inflation for the RBA, whereas it's inflation and employment in the US. So while that unemployment rate remains below 3.9 in the US, there's really not I don't think there's much of a chance that they're realistically going to be going into any sort of aggressive cutting cycle. So, I think May is probably fairly reasonable. It could even possibly be pushed out to June or July sort of thing. So, and I think what you saw was just the froth coming up the top of the tech stocks in the US overnight.
All right, we'll get to that point in a moment, but just on the RBA point, when you mentioned their mandate is different and it is very much about controlling inflation, that cooler print yesterday. So are we done then from hikes? I
think we're done from hikes, absolutely. But it doesn't mean we can't stay at the same level for a good 6 to 9 months. I think there's around about 500 odd days on average between cycles. So that puts it towards the end of this year, which I think's around about reasonable. And then they've got space to potentially cut rates if we start to see employment turn nasty. I think that's the leading indicator they'll be looking at the most. But inflation's now under control. It's still not within the target band. But realistically, they are generally quarterly numbers that they're taking paying most attention to in Australia. So, we're at least 3 months away from getting another clue. In the States as well, I think you probably need almost about another quarter of data before they can make sort of definitive decisions. All
right, let's get back to the tech stocks though, because they fell quite hard in the US session. Is that a mixture of disappointment about what the Fed had indicated, or is it also this big push that we've seen into AI, investors now getting worried, how much is that going to cost? How much is that going to hurt?
Yeah, and they've largely priced in pretty much the next 7 years possible, economic return in the US in basically less than a year. So this happened back in 2001 in the tech bubble as well. And these companies are still great quality companies, but the market does tend to get a little bit carried away with the possibilities. I think even most of the Mag 7 that have reported so far, and we've got 3 of the big ones tonight, Amazon, Apple and Meta, they've actually all beaten expectations on both top and bottom line, and they've been pretty hammered. Like Google was down 7.5% last night. They weren't bad results against analyst expectations, but that just sort of probably goes to show that the market is now realising that, a little bit of a reality check coming back into the market going, well, this is not just going to be unfettered growth forever. We have priced in a lot. We maybe just need to, take a little bit of risk off the table. So, and a lot of the damage has been done in those small caps. I mean, if you take out the Mag 7, the average PE in the S&P is somewhere in the 17 mark. It's actually fairly reasonable. Whereas I think it's somewhere around the 40 or 50 mark, say, for the Mag 7. So they are extraordinarily frothy compared to the rest of the market. They are high quality companies that are very cashed up. However, it's, if they drop 10% odd, it's really, they're still going to be valued higher than the rest of the market. Yeah.
All right, let's have a look at our market then and heading in towards reporting season. We mentioned we've come back off those record highs today. Martin Lakos from Macquarie was just saying to me, watch all of the the broker upgrades at the moment, because maybe that'll give us an indication. And I've noticed a lot of upgrades for healthcare, speaking of the adoption of AI. What sort of sectoral moves, or what are you looking out for in reporting season?
Yeah, we've been really strong in healthcare and agriculture since probably third quarter last year. Just moving more towards, apart from the fact that they were the two most downtrodden sectors for 2023, they're providing good buying opportunities, but they're also defensive. They're in the needs section of the economy rather than the wants. So, we've got some great healthcare names in Australia, etc. So, I think it's the ASX is a little bit hard done by today. I mean, that was tech that really came off last night. In the scheme of things, the Nasdaq's still 30% ahead on a 12-month basis. We had better manufacturing data out of China. And today and yesterday in expansionary territory, so those miners might sort of start to support it. And I think you'll see pockets of strength in the earnings results. I think there's still some really undervalued companies out there overall, because a lot of them haven't recovered from when the market got hit in October. Well, certainly not to the extent that the CBAs of the world or the BHPs of the world have. So in that belly of the ASX and maybe some of the smaller caps, I think there'll be some great opportunities over the course of the earnings season.
You mentioned CBA there, though, and it's coming off records. Are some of these companies looking potentially frothy when you look at Fortescue, BHP, CBA?
Fortescue's quite funny. Like, the analysts are always negative on Fortescue, and yet it just keeps rallying.
Keeps going,
it's quite amazing, really. We're not in any of those at the moment. They normally are, core holdings. We think they're a touch expensive at the moment. We tend to take a bit more of an active approach, and sort of, we'll get out when they start to look more expensive. CBA particularly, the big four generally only have positive years when the money supply is contracting and there's more mortgages, which hasn't really been the case in the last year. So it'll be interesting to see how they go on earnings. I think CBA particularly just gets an uplift every time the index goes up because the money has to go there. But I certainly don't see them getting whacked for any stretch of the imagination. But they are quite high at the moment. They're certainly not a screaming buy overall. But look, it's things like CSL. We were at $238 3-4 months ago. And the world was ending for healthcare because of GLP-1 drugs. So,
and what is it, 300 or something
it's
now?
301 now, and ResMed's bounced about 25% as well. So, there's still a lot of noise out there. So you still got to, be active with your risk management, etc. But there will be some value around earnings season because we're much more of a value-based index rather than the companies that make money that pay dividends, etc. Whereas the US is very much about forward earnings, so they are going to be a lot more whippy. But I think the ASX 200 should hold up better if the Nasdaq starts to fall away. I think we'll probably find support a lot faster than what they will.
All right, Mark, great to get your insights. Thanks so much for coming in. Of course, Mark Gardner there from MPC Markets. Let's have a quick look at some of the gains and losers of the market in a down day. Credit Corp, the winner though, up by almost 6%. Tabcorp, A2 Milk, Fisher & Paykel and Bapcor, of course, we mentioned changes at the C-suite. They're all rising. Some of the losers today, Emerson Electric down 3%. I feel like we could have found more losers than that in a downbeat day. That might be a bit of an error. We'll take that off and have a look at the small end of town. Hazer up by 11.5%. We spoke to that company earlier. Of course, it found or developed, produced hydrogen. Australian Vanadium up 10%. Let's have a look at the laggards as well. Catalyst Metals down 16%, ResDev off 12.5%. And the stock of the day was Nufarm. Howard Coleman of Team Invest and Grady Wolf of Bell Direct joined us with their verdict on today's episode of The Call.
Their FY23 results were great. It was ahead of Bell Potter expectations. So we actually have a buy rating on them. Shares are down 12% over the last 5 years and down 5% over the last year. But we just definitely see it as a buy, like a buy-in opportunity. And that's what Bell Potter's analyst said. So
hasn't hardly moved. If anything, it's gone backwards. Okay. So whenever I look at Nufarm, I think bad news. And it doesn't pass our filters.
All right, let's take a look at what is happening in the overnight session. We've got US non-farm productivity, unit labour costs, construction spending, manufacturing and jobless claims, the Challenger jobless report as well, and then a number of earnings that, of course, we were just seeing in terms of what we had from the big tech players, Apple, Amazon, Meta, Merck, Royal Caribbean, Peloton, Clorox and US Steel will all come through with earnings. And of course, what we can expect tomorrow, Friday, we're going to have a producer price index here, building permits coming through from New Zealand. And then, of course, tomorrow night, we'll be talking about the key jobs numbers in the US. Mark making a very good point that the Fed's mandate is not just about reining in inflation like the RBA's is, but also about ensuring that that unemployment rate is steady. Factory orders will also come through tomorrow night in the US. A quick look at where the market is, and I also liked Mark's comment that it's been unfairly hit today. We did have that record on the ASX yesterday, the CBO 200 down 18 points, 1.2%, and having a quick look at where the ASX 200 is sitting, retreating from that record and back below 7,600 points, down 94 points, 1.2%, 7,586. And I'm just going to get you the actual top leaders and laggards as well, because I think we had a bit of an anomaly there with our graphics. And in fact, when it comes to the declines, Chalice Mining, Emerald Resources, Regis Resources, Siona Mining and IGO were the biggest laggards on the ASX 200. When it came to the winners, we had Credit Corp, Tabcorp, Domino's, A2 Milk and Fisher and Paykel. All right, that does it for another day here at ausbiz. Another busy day on markets. We'll be back from 10 a.m. Eastern tomorrow. Have a good evening.